Listen, I need you to understand something that happened just 72 hours ago, something that erased more wealth in a single trading session than most people will see in 10 lifetimes. On Friday, January 31st, 2026, the gold market experienced what traders are calling the most violent single-day collapse since 1983. We're not talking about a gentle correction here. We're talking about an 11% free fall that vaporized roughly $15 trillion from precious metals markets in a matter of hours. Silver? Even worse. It crashed 36%, the worst single-day decline in recorded history. Now I know what you're thinking. You're thinking this is just another YouTube finance guy trying to scare you with big numbers. But here's what makes this different. This wasn't just a crash. This was a liquidation event triggered by something most retail investors didn't even know was possible. 3 weeks ago, on January 13th, the CME Group, which is the exchange where most gold and silver futures are traded, made a quiet announcement. They changed their entire margin system from fixed dollar amounts to percentage-based requirements. Gold margins went to 5%. Silver margins went to 9%. Most people ignored it. It seemed technical, boring, the kind of financial plumbing nobody pays attention to until the pipes burst. Well, the pipes just burst. But that's only half the story. Because on Thursday evening, January 30th, something else happened that set this entire chain reaction in motion. News broke that a specific individual was being nominated as the next chair of the Federal Reserve, someone the markets view as having very different ideas about monetary policy than what we've seen over the past few years. Kevin Warsh, former Fed governor during the 2008 crisis, known for opposing the massive money printing programs that defined the last decade and a half. The moment that news hit, the US dollar spiked. Bond yields jumped. And every single person who had piled into gold and silver as a bet against the dollar suddenly found themselves on the wrong side of history. But here's where it gets really interesting. This wasn't just scared investors hitting the sell button. This was forced liquidation. Because when the CME changed to percentage-based margins, every single point that gold or silver dropped meant traders needed to deposit more cash to keep their positions open. Think about that for a second. You're a trader holding gold futures. The price starts dropping because of the news about the Fed chair nomination. Suddenly, you get a margin call. You need to deposit thousands more dollars just to keep your position. You don't have it, so you're forced to sell. Your selling pushes the price down further, which triggers more margin calls, which forces more selling. It's a death spiral, and on Friday, that spiral consumed the entire precious metals market. Gold had hit an all-time high of $5,608 per ounce just hours before on Thursday. By Friday afternoon, it had crashed below $4,900. Some people who had been millionaires on paper Thursday night woke up Friday evening completely wiped out. Now, you might be sitting there thinking, this doesn't affect you. You don't trade futures. You don't have margin accounts. Maybe you own some physical gold. Maybe you have shares in a gold ETF. Maybe you don't own any gold at all. But here's why you need to pay attention. Because what happened on Friday raises a question that should keep every single person who owns any kind of wealth preservation asset awake at night. Was this a natural market correction after prices got too hot? Or was this something else? Was this a coordinated move to protect the dollar system itself? Look at the timing. Gold had doubled in 12 months. Central banks around the world were buying it at record pace. Countries were openly discussing moving away from dollar-based trade. The precious metals market had become a referendum on whether people still believed in the stability of paper currency. And then, right at the peak of that rally, two things happened simultaneously. The CME implements a margin system that makes leverage more expensive than ever. And the next Fed chair is announced as someone committed to shrinking the Fed's balance sheet and defending the dollar's strength. Coincidence? Maybe. But the people who got crushed on Friday aren't buying that explanation. They're calling this the Great Gold Liquidation. Some are comparing it to 1980, when similar margin changes broke the Hunt brothers' attempt to corner the silver market. Over the next few minutes, I'm going to walk you through exactly what happened, who made money on this crash, why some very smart analysts still think gold could hit $20,000 per ounce, and most importantly, what this means for anyone who owns or is thinking about owning precious metals. Because despite this brutal correction, gold is still up 69% year over year. Silver is still up 164% year over year. The bull market might not be over, but the rules just changed completely. Let me show you exactly how this unfolded, because the details matter more than you think. Thursday, January 29th. Gold hits $5,608 per ounce, a new all-time high. Silver is trading at $121, also an all-time record. The precious metals market is euphoric. Every financial news outlet is running stories about the gold boom. Retail investors are piling in. Your neighbor, who never talks about investing, is suddenly asking you about gold coins. Classic top signals, right? But nobody wants to sell when everything's going up. Then Thursday evening, the news breaks. Kevin Warsh is being nominated as Fed chair. Within minutes, the US dollar index starts climbing. Bond yields tick higher, and gold starts slipping. By Friday morning, when Asian markets open, the selling has intensified. Gold drops 3% in the first hour of trading. That doesn't sound like much, but in a leveraged futures market, that 3% move can wipe out someone's entire account if they're using 10-to-1 leverage. The margin calls start coming in. Traders scramble to deposit more cash. Some can't. Their positions get automatically liquidated by their brokers. That selling pushes prices down further. By the time European markets open, gold is down 6%, silver is down 15%. The ETFs are getting hammered. Of the iShares, Silver Trust loses 31% in a single session. Its worst day on record. The ProShares Ultra Silver Fund, which uses leverage, gets absolutely demolished, down over 62%. Mining stocks are collapsing. Cure Mining drops 17%. Across the board, companies that mine precious metals are seeing double-digit losses as investors realize that lower metal prices mean lower profit margins. But here's what's really fascinating. While all this chaos is unfolding, the CME announces another margin requirement increase, effective after market close on Monday, February 2nd. Gold margins are going up to 8% from 6% for what they call non-heightened risk profiles. Let me translate that. They're making it even more expensive to trade gold on leverage, right in the middle of a crash. It's like raising the speed limit after someone's already crashed their car. Now, at this point, you'd think the selling would eventually exhaust itself. There are only so many over-leveraged traders, right? Eventually you run out of forced sellers and the market stabilizes. But that's not what happened, because something else was going on beneath the surface. Multiple analysts have pointed out unusual trading patterns. Large institutional sellers appeared to be actively pushing the market lower, not just liquidating positions, but initiating new short positions. There are reports that one major financial institution closed billions of dollars worth of silver shorts at almost the exact bottom of the crash, around $78 per ounce. Think about what that means. Someone knew exactly where the bottom was going to be. They timed it perfectly. While retail traders were panicking and selling at any price, sophisticated players were buying at the lows and covering shorts for massive profits. Some people are calling it market manipulation. Others say it's just smart trading. The truth is probably somewhere in between. When you create a system where margin requirements can force automatic selling, it's not manipulation to recognize that pattern and trade accordingly. By the time Friday's trading session ended, the carnage was complete. Gold settled at $47.45, down 11.4%. Silver closed at $78.53, down 31.4%. Platinum and palladium were also crushed, though not quite as severely. Monday, February the 2nd, this week, the bleeding continued. Gold tested below $4,400 before recovering slightly to around $4,800. Silver dropped again, falling below $81 at one point before bouncing back to around $83. As of this morning, we're seeing some stabilization. Gold is holding around $4,700. Silver is hovering near $83. But the volatility is unlike anything traders have seen in decades. Here's what's important to understand. This type of price action doesn't happen in mature, stable markets. It happens in markets where structural imbalances are being violently corrected, where too much leverage meets too little liquidity meets a fundamental shift in sentiment. The fundamental shift was the Warsh nomination. The leverage was the futures market. The lack of liquidity was the combination of traders all trying to exit at once, while the CME was simultaneously making it more expensive to maintain positions. Perfect storm doesn't even begin to describe it. This was a financial tsunami that caught almost everyone off guard. The only people who made money were those who either got lucky being out of the market entirely, or those sophisticated enough to recognize the setup and profit from the chaos. The question now is, what happens next? And that's where things get really interesting, because despite this crash, the fundamental case for gold hasn't changed at all. Here's what nobody's telling you about this crash. Despite losing nearly $900 from peak to trough, gold is still up 6.9% over the past month. Year over year, up 69%. Silver, even after its worst day in history, is still up 8.4% this month and a staggering 164% year over year. Let that sink in for a moment. We just witnessed what traders are calling a generational crash, and both metals are still massively profitable for anyone who owned them a year ago. That's not how bubble bursts typically work. When the tech bubble popped in 2000, those stocks didn't recover for years. Some never came back at all. When housing crashed in 2008, property values took almost a decade to return to previous peaks. Real bubbles leave behind wreckage and regret. But gold and silver? They corrected violently and are already showing signs of stabilization. The physical market is telling a completely different story than the paper futures market. Coin dealers are reporting they can't keep inventory. Physical silver premiums, the markup you pay above spot price for actual coins or bars, have barely budged during this crash. That tells you something crucial. The people buying physical metal aren't panicking, they're buying the dip. Meanwhile, the futures market remains volatile as traders try to figure out what comes next. And that's where the story gets really interesting, because some of the smartest analysts in the world are doubling down on their bullish forecasts despite this crash. UBS, one of the world's largest banks, just raised their gold price targets. They're now calling for $6,200 per ounce by September 2026. That's a 24% increase from their previous forecast. In an extreme scenario where geopolitical tensions escalate significantly, they think gold could reach $7,200. Think about that. A major financial institution watched gold crash 11% in a single day and responded by raising their price target. Why? Because the fundamental drivers behind gold's rally haven't changed. In fact, they've arguably strengthened. Let's go through them one by one. First, central banks. Countries around the world are still buying gold at near record levels. China, Russia, India, Turkey. They're not buying paper gold contracts that can be liquidated with a margin call. They're buying physical bars and storing them in vaults. That demand doesn't go away because of a futures market crash. Second, currency concerns. Yes, the dollar rallied when the Warsh nomination was announced. But why did that nomination spook markets in the first place? Because it signals the end of the easy money era. The Federal Reserve has spent 15 years expanding its balance sheet to unprecedented levels. Warsh is known for wanting to reverse that. But here's the thing. Reversing quantitative easing isn't the same as making the dollar stronger long term. It's more complicated than that. If the Fed tries to shrink its balance sheet too aggressively, it could trigger a recession. Recessions historically drive investors into gold as a safe haven. Third, geopolitical instability. I'm not going to get into specific conflicts or situations because they're constantly evolving, but you can look at a map and see multiple regions experiencing significant tensions. Those situations don't resolve themselves overnight. Uncertainty is gold's best friend. Fourth, and this is crucial, the technical setup for gold might actually be bullish after this correction. Here's why. When a market crashes on forced liquidation rather than fundamental deterioration, it often creates what traders call a spring or a shakeout. All the weak hands get flushed out. Over-leveraged speculators get wiped out. What's left are long-term holders and value buyers. Several technical analysts have pointed out that gold formed what's called a pin bar on Friday and Monday. That's a candlestick pattern where price spikes down dramatically, but then closes near the highs of the day. It suggests that selling pressure got absorbed and buyers stepped in at lower levels. It's often a reversal signal. Amada Siri, a strategist at Pepperstone, identified $4,600 as a critical support level for gold. As long as that holds, he says the path to $6,000 remains intact for 2026. We're currently trading above that level. Silver is showing similar patterns. After crashing to $78 Friday, it's recovered to the low 80s. The fact that it didn't completely collapse tells you there are buyers waiting at these levels. But the most interesting voice in all of this might be someone who's been warning about the monetary system for decades. Former Congressman and longtime gold advocate Ron Paul just reaffirmed his prediction that gold will eventually reach $20,000 per ounce or higher. His argument isn't about short-term trading or technical patterns. It's about the fundamental sustainability of the current financial system. And that's the conversation we need to have next. Let me tell you why some people think this crash was actually engineered to protect something much bigger than gold prices. When gold hit $5,600 per ounce, something unusual was happening in the financial system. Not just the price itself, though, that was remarkable. It was what the price represented. Gold breaking record after record was becoming a daily referendum on whether people trusted paper currencies. Every new high was implicitly saying that people had less faith in dollars, euros, yen. Every central bank purchase was a country essentially voting with its reserves that the current monetary system might not last forever. That's a dangerous narrative for any government to allow to spread, because the entire modern economy is built on faith in fiat currencies. The moment that faith cracks, everything else starts to crumble. So when you look at what happened with the margin changes and the timing of the Fed chair announcement, you have to at least consider the possibility that these events weren't entirely independent. The CME changed its margin methodology on January 13th. They'd been using fixed dollar amounts for decades. Suddenly, they switched to percentages right as gold and silver are going parabolic. The official explanation was market volatility and adequate collateral coverage. But here's an interesting question. Why didn't they implement percentage-based margins years ago when gold was trading at $2,000 or $3,000? Why wait until it hits $5,600 to suddenly decide the old system isn't working? Some analysts have pointed out that percentage-based margins effectively cap how high prices can go before leverage becomes prohibitively expensive. At 9% margin on silver, you need massive capital to maintain large positions. That naturally limits the ability of speculators to drive prices higher. It's similar to what happened in 1980 with the Hunt brothers. They tried to corner the silver market. They drove prices from $6 to $50 per ounce in less than a year. Then the COMEX, now part of CME, changed the rules. They implemented Silver Rule 7, which basically said you could only sell silver futures, not buy them. That rule change broke the Hunt brothers' position and crashed silver back to $11. Many people never forgot that lesson. When you see similar rule changes during a precious metals rally, it raises eyebrows. Now, I want to be clear. I'm not saying there's some grand conspiracy here. Markets need rules. Excessive speculation can create real systemic risks. When clearinghouses worry about their ability to cover potential losses, they have legitimate reasons to raise margin requirements. But the timing matters, and the effect matters. Whether intentional or not, these margin changes had the effect of breaking a rally that was beginning to challenge some fundamental assumptions about the global monetary system. Think about what was happening before the crash. Gold had nearly doubled in a year. Silver had risen over 140% in 2025 alone. Countries were openly discussing moving away from dollar-denominated trade. The BRICS nations were talking about alternative payment systems. This wasn't just investors hedging inflation. This was the early stages of a potential monetary regime change, the kind of shift that happens once in a generation or once in a century. And then Friday happened. $15 trillion evaporated. The narrative shifted from gold to the moon to, was it all a bubble? Suddenly, everyone's talking about profit-taking and overextended speculation rather than monetary system failure. That shift in narrative matters enormously. It buys time for the existing system. It creates doubt among investors who might have been considering moving more wealth into hard assets. It reminds everyone that the establishment still controls the infrastructure where these assets trade. But here's the problem for anyone who wanted this rally stopped. You can force liquidation. You can change margin requirements. You can trigger a crash. What you can't do is change the fundamental reasons why people were buying gold and silver in the first place. Those reasons are still there. Government debt is still exploding. Central banks are still caught between controlling inflation and supporting economic growth. Geopolitical tensions are still high. The financial system is still built on unprecedented levels of leverage. One crash doesn't fix any of that. It just gives everyone a chance to catch their breath and reassess. Which brings us to the critical question facing anyone who owns precious metals or is thinking about buying. What do you do now? Do you sell and take whatever profits you have left? Do you hold and hope for a recovery? Do you buy more at these lower prices? There's no simple answer, because it depends entirely on why you own gold or silver in the first place. And that's what we need to talk about next, because your answer to that question should determine your entire strategy going forward.